Hi, everyone. So welcome to the live stream today. Very much excited for having you on the second day of session 2 in our discussion towards the ICA May 2021 examination. Yesterday, we started with a discussion looking at the IFRS standards and how we actually apply them in the exam hall. And I made mention of the fact that the IFRSs or the accounting standards are critical. They are the basics for you to be able to pass your corporate reporting exams, because that is 30% of the exams, and then to be able to also pass your financial reporting exam, because you're going to have over 40% coming in based on the accounting standards, because each footnote in dealing with a single entity financial statement, whether the statement of profit or loss and other comprehensive income, the statement of changes in equity, and the statement of financial position, as well as the cash flow statement, all of these financial statement preparation, the footnote requires accounting standards application, which is very critical in order for you to pass the examination. So today we want to continue with where we left yesterday, starting with the accounting standards that we were looking at, IAS 16. Then we're going to be focusing on the issue in relation to IFRS 16, IFRS 15, and then IAS 12 in relation to that. So we're going to continue with IAS 16, property, plants, and equipment. We will look at IAS 12. Yesterday, I introduced you to the deferred tax aspect when we are dealing with IAS 16. And we're going to be looking at a question in a moment to look at how defect tasks can actually be taken into consideration when dealing with IAS 16. Then we're going to be spending some time to also look at IAS 38, impairment of assets, and bring some questions up, because remember, it is one thing to understand the standards, it's another thing to be able to apply the standards or actually solve questions with the standards. So thank you very much for joining me. In case you missed yesterday's lecture or the part 1, I'm going to be dropping it in the description for you to get it to watch. For those of you who are watching on Facebook, you can go to the YouTube channel and it is in the description. You can watch that and that will help you to build up in this case. Welcome to the live stream. I see some of you guys joining. Give us a thumbs up on the video and share the video. Let us reach as many students as possible watching the live stream from across the country, across the continent, and across the globe. Let us reach as many students as possible, because as always, my objective is to be able to provide you guys with these kind of contents so that you don't just understand the standards, but you know exactly how to apply the standards in order for you to increase the chances of passing the examination and taking your life to the next level. So let's take some comments real quick coming in on Facebook. On YouTube, rather. Benedicta Amankwa said, when will you teach IFRS 15? Benedicta, stay tuned, because we are likely to be taking that as part of the session today, because as you can see in our title, there is IFRS 15 there, revenue from contract with customers. So stay tuned, Benedicta, and we're going to be taking that. Joycelyn Sober said, good afternoon, Nhyira, how are you? Joycelyn, I'm flourishing and I hope that you are also doing well. Omar Rousseau said, hi, my noble mentor, Nhyira. Hello, Omaru. I hope that you're doing well. Nelson Abiti said, good afternoon, sir. Good afternoon, Nelson. I hope that you're doing well. Apieje Kweku said, Nhyira, good afternoon. How are you doing? Apieje, I'm flourishing and I hope that you're also doing well. You are all welcome to the live stream. Let me share my screen and let's begin the journey real quick from where we left yesterday, solve some questions and get some knowledge in the discussion today. So let's see real quick, sharing my screen with you. There we go. Facebook, I see some of you guys joining. You are welcome. Comment in the chat box. Let me know in the comment section. Facebook is a comment section. Let me know where you are watching from and any questions you have for me. Also comment in the comments section. Also, if you have any questions for me and the topics you would want us to cover in the discussion, the topics you would want us to cover in the discussion. So let's see what we got there. Yesterday, we started with IAS 16 and we spent some time to look at the various things that we need to understand when it comes to the IAS 16. We looked at the recognition criteria, the subsequent measurement. We discussed all of the issues in that case. John Malongo said, Nhyira, good afternoon. You're doing extra to us. God bless you. Amen. God bless you too. Ahas Timothy said, good evening, sir. Good evening, Timothy. I hope you're doing well. Henry Tete Barriga said, good day, sir. Trust you're doing good. Yes, Henry, I'm flourishing and I hope that you're doing well. Nelson Abiti said, sir, please, my question is on taxation. I'm sorry to send you back. Okay, so what is your question on taxation? I've not really covered taxation in general, but put a question in the comment box for me. What is it about? And let me see if we can put it inside, because IAS 12 is one of the standards we are discussing in this series. So Nelson Abiti put it in the comment section or in the chat box, and I'm going to be answering it for you. Kwabena Amponsa Eshon on Facebook said, how are you doing? I'm flourishing, Kwabena Amponsa, and I hope that you're also doing well. So yesterday, if you remember, we ended on dealing with the deferred tax effect on revaluation. So we mentioned that when there is revaluation of assets, there could be a deferred tax effect on that we need to look out for. So in order to make the knowledge sink very well, and in order to help you to really apply the concept, I want to pick a question straight up for us to look at how revaluation gain and then the deferred tax on revaluation gain is actually going to be treated. So this is the question we have here. You can take a snapshot of it. It's a short question, so you can take a snapshot of it real quick. And what we want to do with this question is to find out how we can treat upward revaluation. Okay, so when there's upward revaluation, and there is a deferred tax effect on that upward revaluation, how is it supposed to be treated in the financial statement? So you can take a snapshot of this question, and then let's get a discussion going. Now, note that we will be also spending some time to look at the issue in relation to how we will do the downward revaluation in a moment, but I want the knowledge to sink and teach you how to apply what we learned yesterday. So that is why we are picking up this question. So take a snapshot. Now, for those of you who are my financial reporting students, like you are enrolled in our course, this is already in your revised kit on page 60. So in your revised question kit, you can just go there, page 60. You don't have to retake the snap in that case. This is our question kit. It's 187 pages. And the fun part is that it has a lot of questions on every standard that it is you need to know about, and it's a question kit. And this is what you get when you enroll to study directly under my mentorship for your examination. So let's go there in relation to that. Clark bought a property for $500,000 on 1st January 2013. On December 2015, the property had a carrying amount of $420,000 and was revalued to $800,000. The tax written down value at 31st December 2015 was $420,000, and the tax rate is 20% required. Explain how the revaluation, including any deferred tax impact, should be dealt with in Clark's financial statement for the year ended 31st December 2015. Now, you've got to be careful about the years happening and then the language that the examiner is using in the question, because that is critical in relation to that. Now, the asset was bought on 1st January 2013. Then we are told that on 31st December 2015, which is actually also the year ended of the company is now revaluing the assets. And as at that date, the carrying amount is $420,000, meaning that any depreciation chargeable has already been charged. So we're giving the carrying amount or the carrying value of the asset. Now, the tax written down value of the asset is $420,000. So how should we treat this transaction in our books? So Clark. So this is from section 2. And we go to Clark. Now, so there are two standards that are here that we need to pay attention to. There is an IAS 16, how you deal with revaluation surplus. And also there is an IAS 12, how we deal with deferred tax on the revaluation. So two standards merge. And yesterday I made mention to you, that is what the examiner is really excited about. So let's look at what is going on there. So let's bring in the carrying amount. As at 31st December 2015, putting our dollar sign up, and that is 470,000. Sorry about that. 470,000. Then we bring in the fair value or the revalued amount. Maybe let me go that way. Take note that the revaluation is occurring at the end of the year, okay? And the revalued amount is $800,000. So the balancing figure on this becomes what? The revaluation surplus. Or revaluation gain, which is going to go to the OCI. And that's how much? 800 minus 470, I'm getting 330. Okay. Now, assuming the examiner hadn't given us the tax written down value of the asset and then the tax rate, we would have just ended here and extract our financial statement, take the 330 to the statement of other comprehensive income, and on the face of the statement of financial position for the year ended 31st December 2015, the asset to be carried at $800,000. Simple. We would have just ended there. But because in the question the examiner had given us the tax written down value of the asset, it means something is supposed to going to happen here. So we have revalued the asset to $800,000. The tax authority doesn't know anything like revaluation, like I told you yesterday. So the tax written down value or the tax base of the asset is $420,000. So we're going to pull that up and bring in here tax written down value. And that is also like the same as the tax base. And I think that is 420,000. So if you realize, you will see that the revalued amount is greater than the tax base of the asset. For that reason, that leads us to a taxable temporary difference. Taxable temporary difference. Now, once there is a taxable temporary difference, it means that we are going to get deferred tax liability. So assuming the tax written down value was was more than the revalued amount, then that will be called deductible temporary difference, and that will result into a deferred tax asset. That will result into a deferred tax asset. So let's get a temporary difference, 800, 420. I'm getting 380,000 there. So on this temporary difference, we're going to be applying our tax rate so that we can get a deferred tax coming in. So the deferred tax, it's going to be 20% of 380,000. And I'm getting 76,000. So that is the deferred tax. That is the deferred tax. But this is where you got to be careful. You see, usually deferred tax is supposed to be taken to the P&L account, but it's not all the time like that. When the deferred tax is arising as a result of revaluation of assets, the movement in deferred tax will usually, by default, be treated in the other comprehensive income. Let that sink in your head very well. When there is a deductible temporary difference or taxable temporary difference as a result of revaluation of assets, by default, it is treated in the other comprehensive income and not in the statement of profit or loss. So we are getting 76,000, and the 76,000 is the deferred tax. But the question is, will all the 76,000 be taken to the income statement, or will all the 70,000 be taken to the other comprehensive income? No. So how do we split the 76,000 into the amount that goes into the other comprehensive income and into the amount that goes and the amount that goes to the income statement. So this is what we're going to do. We have our deferred tax, 76,000 coming up. Now, the amount of deferred tax chargeable to the OCI, it's based on the revaluation surplus. So, charge to OCI, it's going to be the revaluation surplus, which is 330,000, multiplied by 20%. And I'm getting 66,000. So that the rest of it will be taken to the income statement. So the balancing figure will be the charge to the P&L. Charge to profit or loss, and that's 10,000. Are we done with the question? No. We're still just on the workings in relation to that. So now let's extract the financial statements. Now, in case you don't understand something, please make sure you indicate. So statement of profit or loss and other comprehensive income. You want to write these in full because in the exam hall, if you do this, and that's an extract. Now, there is nothing like depreciation in the question. They've already charged depreciation because we are working there with the carrying amount as at 31st December. So we will go to the other comprehensive income stream. Sorry, something has to go to the income statement. So the deferred tax going into the income statement will be brought. That is the 10,000 will be brought here. Then we bring in the other comprehensive income. So in the other comprehensive income, remember we have revaluation surplus. So we did the workings for that. Now it's important for us to number our workings. I think I tell my students all the time that, so this could be workings 1, then the deferred tax separation, could be workings 2. Okay, so that we can professionally present our work. So this is from workings 2, this is from workings 1. We are getting a revaluation surplus of 330,000. Okay, then we bring up the deferred tax that is supposed to go to the OCI, and that was 66,000, and that's going to be deducted. That's going to be deducted. Okay, that's going to be deducted. So that is the statement of profit or loss and other comprehensive income. We bring in the deferred tax that is supposed to be taken to the income statement. Now, the reason why the balancing figure is going into the income statement is because that is where it has to be. Only the amounts chargeable on the deferred on the revaluation surplus that is going to go into the OCI. So the balancing figure has to go into the income statement in relation to that. Then we look at the statement of financial position, also an extract. We bring in the assets. Then we have the non-current assets. Under that, we will have, what was the asset we bought? We will just do property. Okay, so property. It was given directly to us in the question. So 800,000, that's going to be brought. Then we go to equity and liability. So under equity, we're going to be looking at the revaluation surplus. Now, note that you had a revaluation surplus of 330. What kind of, please give me a moment. There are some morons who try to just post nonsense under people's pages. So 330,000 minus the 66,000. So the revaluation surplus is going to be 330 minus 66. That's 264. Okay. Then we go to liabilities. Under non-current liability, we'll have deferred tax. From workings 2. I think the deferred tax is actually from workings 1. The whole 76,000. So that is the answer to the question. So you realize that this is just an extract we are preparing, okay? But look at the way I'm taking my time to write out everything. And it's very, very important to do the right thing in the exam hall. So I see some comments coming in. Let me pick them real quick. In that case, Kwabena Amponsa Ishong said, I'm really enjoying it. Thank you, Kwabena. On YouTube, we said we are having a question from Nelson Abiti. He said, when employment income and business income is joined in one question, will you treat it differently, especially tax relief? No, if you are dealing with the income of individual, the total accessible income of individual shall be income from various sources. So the business income is going to be coming in, dealing with issues about capital allowance, adding back depreciation and all that. Then the reliefs will be granted usually from primary employment in relation to that. So the relief will be usually on the primary employment. Then John Malongo said, why the balancing figure is charged to P&L? The balancing figure is charged to P&L because if you are looking at the statement of profit or loss and OCI, if you are taking an amount to OCI, the rest has to be expensed in the profit or loss account. Timothy said, please, Nhyira, at what point do we charge the tax rate on the revaluation gain amount? At all points, as far as you are dealing with the a splitting of the deferred tax into the P&L account and into the other comprehensive income, the one to be taken to the OCI has to always be on the revaluation surplus or the revaluation gain in that case. Apj Kweku said, please go through the appropriation of the deferred tax again, please. Okay, so this is what we said. We said that the whole deferred tax amount we are having is 76,000. So how much of that do we take to the profit or loss? How much of that do we take to the other comprehensive income? So we said that, okay, if the whole amount that we are incurring is 76,000, then the amount chargeable to the other comprehensive income shall be the tax rate times the revaluation surplus. The tax rate times the revaluation surplus. So that is how we get the 66,000. So that the balancing figure, that is the total deferred tax minus what we are taking to the other comprehensive income, becomes the one that we charge to the P&L. So APJ, that is it about that. So let me know if you guys are okay with your questions John, Timothy, Apiej, and Nelson Apiti in that case. I see some of you guys also joining. You are welcome to the stream, and give us a thumbs up on the video. Smash the like button on the video when you join. It helps us a lot. It makes the video more engaging, and YouTube and Facebook will be able to push the video so we can reach as many students as possible watching this video and getting access to these valuable contents so they can prepare their exam. So you liking the video, you are actually helping somebody else to get the video so that they will be able to also get the value you are getting, and together we can help a lot of students, a lot of people. Then we can all become successful in the end. So thank you very much. I see some of you guys smashing the like button and the heart button on Facebook and YouTube. Thank you very, very much. Okay, so Apiej said thanks. All right. So that is the answer to the question on clerk. So you see the application. So it's very, very important for you to understand the principle, then apply the principle. So IAS 16 will have an issue in relation to the deferred tax. And so how do we apply it? This is how we apply it. This is how we apply it. So Timothy said, but this one, we charge it between the tax written down value and then the revaluation value instead of revaluation. I don't understand what you are talking about, though. I don't understand what you're talking about. He said, but this one, we charge it between the tax value and then the written down value instead of revaluation surplus. I don't understand your question or your statement. Because if you want to get your deductible temporary difference or taxable temporary difference, the tax rate applies not on your revaluation surplus. Tax rate applies on the temporary difference, because deferred tax is your temporary difference times the tax rate. It is when we have to split the deferred tax into the other comprehensive income and the P&L that the tax rate will be applied on the revaluation surplus, so that the amount we get will go to the other comprehensive income, then the balancing figure will be taken to the P&L in relation to that. Isaac Idioba said on Facebook, said, please, sir, which question are we solving? I just joined. We are looking at a question. This is the question. You can take a snapshot of it. But Isaac, I guess you are already my student, a paid student there. So it's on page 60 on your revised kit. That is the question I'm looking at. It's on page 60 in the revised kit. So this is it. You can take a snapshot if you already don't have it, but it's on page 60 of your revised kits. And that is what we are just looking at. So Timothy, let me know if your confusion has been dealt with, if what you were trying to say, I've clarified that for you. Toby said, good evening, sir. Good evening, Toby. You are welcome to the stream, and thank you for joining us. So that is what we mean by upward. If you are not given a tax written down value, then there is no need for you to calculate any deferred tax. So Timothy is asking, what if the tax written down value is not given? What is the way forward? If you are not given anything about tax, then you just deal with the IAS 16 aspect, get a revaluation surplus, take it to the OCI, and you go away. If the entity makes transfer, you do the transfer and you go away. But if the examiner gives you something about tax, he gives you something to calculate capital allowance, or he gives you the tax written down value, then IAS 16 would have to come in relation to that. So if you're not given anything about tax, the tax written down value, or something to calculate the capital allowance so that you arrive at the tax written down value, then there is no IAS 12 effect there. You just focus on the IAS 16 aspect and treat it the way you have to treat IAS 16. Henry Tete Brigadier said, I asked a question, but it seems you skip it. Really, Henry? Let's see. Henry, it doesn't look like you don't have any question in the comment. Maybe you typed it, but you did not click on it. So you can retype it again because Henry, I've not seen any question of yours here. The only thing I see here is when he said, "Good day, Nhyira. I trust you're doing well." After that, you've not typed any message like that. You do not type any message. So you can retype your message and I will look at it in that case. John says, "Sir, can we do the question 2, page 59? No, I have an objective of what I'm doing on the stream here. So I have an objective of what I'm doing on the stream here. So Kwabena Amponsa Eshon said, "Sir, please, I'm in Takrade and can you help me with the revision timetable?" When you say the revision timetable, I don't understand what you mean though, but our revision session that we are having here on YouTube for you guys is something that we are doing for you guys, but our revision session, it's not open to the public. It is strictly for our students. So we have our executive revision masterclass, which has already started about 7 weeks ago, and we are doing that, and we're going to be intense on that 2 weeks from next week. In that case, today we started with our dawn project, which is 2:30 a.m. to 5 a.m. and it was just fun there, and that is going to be running for the next 4 weeks in that case. So our revision session, it's not open to the public. It is strictly for our paid students who are learning under my mentorship, and I assist them in that case. What we'll be doing here on YouTube, there is no labeled down timetable. What it is that based on the questions and the requests we receive, these are the things we're going to be covering. So what you want to do is to follow me on Instagram. Then the daily discussion, you will get a notification on that. But there is no way you can really join our full revision session. The only way is if you are a fully paid student in that case. It's not open to the public. I don't run an intervention class for the exams. I don't do that. So we just focus on our students who have been with us all this while. So Kwabena Amponsa, that is what you need to understand. I don't know if that is what you wanted me to say because I was not getting your statement well. Right. So now that we finished with the upward revaluation, so let's get a takeaway here. Let me give you the takeaway so that you can take it away. So what was the takeaway? Let's see. So we mentioned that when it comes to revaluation of assets, there is an upward revaluation. And that is what we've been talking about since yesterday. That when there is an upward revaluation, what it means is that the carrying value of the asset is less than the fair value of the asset. What it then means is that it will result into a revaluation surplus or revaluation gain. Then we stated that because depreciation is supposed to be charged on the revalued amount, what is going to be happening is that we would have to make an annual transfer from the revaluation surplus to the retained earnings because of the fact that the entity will be incurring a lot of or a higher depreciation in the P&L account, reducing profit. So the annual transfer comes in, and that is where we debit the revaluation surplus and credit the retained earnings. Then I made mention of the fact that revaluation can be done. The upward revaluation can occur at the beginning of the year or during the year or at the end of the year. Then I made mention of the fact that, okay, I think there is a question now from Henry. He said, I asked if you are given a revalued amount and a carrying amount and the tax base. Do we compare the revalued amount when you want to calculate the deferred tax liability or assets? Yes, like what we just did here. It is the revalued amount you are going to be comparing with your tax base, with your tax written down value to get a temporary difference. Like what we just did in this question, you realize that we didn't compare the carrying amount with the tax written down value. We compared the revalued amount with the tax written down value. That is how you compute your temporary difference. So we said that if the revaluation is done at the end of the year, then there is no annual transfer. But if it is done at the beginning or during the year, we do a transfer in that. So let's look at the final part of revaluation, and that's going to be downward revaluation. Now, this is an interesting part. So, Henry, let me know if the answer is what you wanted. Kwabena Amponsa said, I'm okay with it. Okay, that's fine. So, downward revaluation. Now, when it comes to downward revaluation, stay with me carefully here. Let me explain the concept to you. There are two things happening on downward revaluation. There could be what is called the first time downward revaluation, and then downward revaluation from a previously upward revalued asset. Stay with me with the concept. Stay with me with the concept. Okay, so Henry said, I got you, sir. All right. So stay with me with the concept real quick in relation to that. Now, when we say first time downward revaluation, what it means is that when the entity buys the asset or bought the asset, this is the first time they are revaluing the asset. So since they bought the asset, this is the first time they are revaluing. And for the first time they revalue the asset, it going to happen, what is going to happen is that the carrying amount is then greater than the fair value of the asset. If the carrying amount is greater than the fair value of the asset, that means that this is going to result into a revaluation loss, or usually could be called impairment loss. It means that the asset has suffered an impairment. So this impairment loss or revaluation loss, because this is the first time we are revaluing the assets, all we would do is that it will be written off as an expenses in the P&L account. Written off as an expense in the profit or loss account. Simple. So since the company bought the asset, this is the first time they revalue the asset. So if they revalue the asset for the first time and the carrying amount is greater than the fair value of the asset, then what is going to happen is that it will result into a revaluation loss or impairment. Since this is the first time we are revaluing the assets, that impairment or revaluation loss will just be treated in the P&L account. So double entry, we just debit the profit or loss account, right? Then we'll credit the property, plant, and equipment in that case. So that is the thing we do there in that case. Timothy A has said, warming up for the dawn class. PSA, okay. Then warm up very hard. 2:30 a.m. we're going to be coming up. All right, so continue your warm up. So that is what we do for the first time downward revaluation. For the first time downward revaluation. Just write it off in the P&L account, period. But this is where the journey becomes interesting. This is where the journey becomes interesting. And stay with me carefully on this one so you get a concept very well. What if, stay with me carefully here. What if the entity had previously revalued the assets and there was an upward revaluation? Then subsequent to that, there is a downward revaluation. In that case, we are still going to be getting a revaluation loss, but its treatment will be different. And this is where I want you to be really, really attentive. So previously upward revalued assets. Previously upward revalued assets. So you are dealing with downward revaluation, which means that definitely your carrying amount is greater than your fair value, which means that you are getting a revaluation loss. However, this asset that is giving us a revaluation loss, previously we had revalued it upward, so it is having a revaluation surplus. So for that reason, what happens is that any subsequent revaluation loss will be written off against the previously recognized revaluation gain, and any excess is then taken to the P&L account. So subsequent revaluation cost, sorry, revaluation loss is written off against previously recognized revaluation gain. Okay, then any excess of the revaluation loss is written off in profit or loss. It's written off in profit or loss. Are you getting the concept here? So unlike the first one, where you would just go and debit P&L and credit the asset, this one, you're not going to do that. So the double entry here is that you're going to be debiting. First, you will credit your PPE with the whole revaluation loss, but you will debit revaluation surplus. Remember, this thing will occur usually in the other comprehensive income. Then the balancing figure will be debited to the income statement. Any questions? That's all you need to understand about IAS 16. Any questions? That's what you need to understand about IAS 16. Any questions? That's all you need to understand about IAS 16. So get the principles. Very, very critical. It's one thing to understand the principle. It's another thing to apply the principle. It's one thing to understand the principle. It's another thing to apply the principle. So let's look at another question about the IAS 16 and certainly also about tax. And let's see exactly what we need to look out for in relation to that. Now, this question is not in your question kit. For those who are my students already, but I'm going to be sharing it on the screen so you can take a snapshot of it, then we'll solve it. So let me go to my drive real quick. Financial reporting. It's an ACCA question. You can download it on Google and get access to it. It's an ACCA past question, September 2016. So if you just type ACCA F7, in ACCA financial reporting is called F7. So you can type ACCA F7 September 2016 and you'll be able to download it. But you can get a screenshot of the question also here. And you want to stay with me on. Now, these questions are objective questions, but you can get this thing in the ICA exams and it will be for 5 marks or for 4 marks, something like that. And you are supposed to make a couple of treatments in that case. So let's look at the question here and let's see what we need to do. So stay with me carefully here, still looking at that. Okay, so John Malongo said, "Sir, come again if it is the first time you're doing the revaluation loss." So what we are saying here is that if it is the first time you are doing revaluation loss, the revaluation loss is written off in the profit or loss account. The revaluation loss is written off in the profit or loss account. So all you do is to debit the profit or loss account with the revaluation loss that you obtained and you credit property, plant, and equipment in that case. So that is what we do in the first time revaluation. Okay, so let's go to the question. So you can take a screenshot of the question. This is the question. You can take a screenshot of it. You don't have this already, so you can take a screenshot of it and let's go through it. It's actually supposed to be used to answer question 16 to 20. We're going to see if it is possible for us to do all of that. So stay with me carefully and let's go. Aphrodite Co. has a year ended 31st December and operates a factory which makes computer chips for mobile phones. It purchased a machine on 1st July 2013 for $80,000. Now, you want to be careful about dates very well when you're dealing with financial reporting, because it's going to be critical and it's going to be playing a key role here. So we bought an asset on 1st July 20x3 for $80,000, which had a useful life of 10 years. And depreciation is done on a straight line basis with time apportioned in the year of acquisition and year of disposal. When we say with time apportioned in the year of acquisition and year of disposal, all we mean is that we are going to be charging the depreciation on a pro rata basis. In other words, 1 month ownership basis in that case, or a month ownership basis. The machine was revalued to $81,000 on 1st July 20x4. There was no change to its useful life at that date. Okay, so stay with me carefully here. The question 16, the examiner is asking us, in accordance with IAS 16, property, plant, and equipment, what is the depreciation charge to Aphrodite Co's profit or loss in respect of the machine for the year ended 31st December 20x4? So let's crunch it up and let's see exactly what we're going to do. So Aphrodite. So let's see what's going on here. The year ended for the company is 31st December. So let's see what's happening here. Let's bring the cost of the assets. That was bought on 1st July 20x3. And we are told that that is $80,000. Remember the year ended we are preparing the examiner is asking us is 31st December 20x4. Okay? But the asset was revalued on 1st July 20x4. So you want to be very careful here in that case. Now, if the year ended is 31st December, that means that for the year ended 2013, we need to bring the depreciation. So depreciation for the year ended 31st December 20x3 will be, now from 1st July to 31st December 20x3, that's 6 months. So we're going to have 80,000 over how many years we got? 10 years times 6 over 12. So let's see. 80,000 over 10, 6 over 12. I'm getting 4,000 there. So we take it out. So as of 31st December year 3, what's happening is that the carrying amount of the assets at 31st December 20x3, it's 76,000. Okay. Now, why am I doing this? Because of the revaluation occurring in the middle of 20x4. So you got to be careful here. So now the asset was revalued on 1st July 20x4, which means for the year ended 20x4, the asset had been used for 6 months before we revalued it. So we bring in the depreciation for period ending or for 6 months ending 30th June 20x4. And that is going to be 80,000 over 10, 6 over 12. And that will still be 4,000. Take it out. And that's going to give us 72,000. Now, the examiner didn't ask us to deal with revaluation surplus or revaluation gain now in the question 16. In the question 16, the focus of the examiner is on the amount of depreciation that we need to charge. But that is how we need to break up our workings to know exactly what we have to do. So this is the carrying amount on 1st July. On 1st July 20x4. But immediately on that date, the asset was revalued. So revalued amount on that same date was, what was the revalued amount? 81,000. So if you check it up, we are getting a revaluation surplus of, that should be 9,000 revaluation surplus. But we need to calculate the depreciation for the 6 months ended 31st December 20x4. So let's bring up the depreciation for the 6 months ended 31st December 20x4. So from July to December 20x4, it will now be 81,000. Now remember, we are told that the useful life of the asset had not changed. The useful life of the asset had not changed. So the question then is, how many years do we have now? How many years do we actually have now? If you look at it, the asset had been used for a year, and we are revaluing it in relation to that. So the remaining 9 years. So it will be 81 over 9 times 6 over 12. Okay? 81 over 9 times 6 over 12. And that's 4,500. So if you want the carrying amount as at 31st December year 4, (20x4) will be 76,500. Does it make sense? But what did the examiner ask us to do? He said we should calculate the depreciation for the year ended year 4. So the depreciation for the year ended year 4 is going to be this amount and then this amount. So it means for the year ended 20x4, depreciation for year ended 31st December 20x4 will be the 4,000 first 6 months of the year, plus the other 4,500 after the revaluation. And so the answer is going to be 8,500. Any questions, please? Any questions? So our answer is going to be D in this case. Our answer is going to be D in this case. Any questions on that? Any questions on that? So as always, I tell you guys, you don't have to read the whole question before you start. You chew the question bit by bit, paying attention to the requirements and exactly what you need in the question. Paying attention to what you need in the question. I hope everybody is okay on that. So that's it about that. Let's go to the next one. And let's see exactly what we have there. Number 17. Number 17, the examiner is asking us, and this is a theory question on IAS 36, impairment of assets. So get it well. So this question is actually the standards that we've been covering so far. IAS 36, impairment of assets, contains a number of examples of internal and external events which may indicate the impairment of an asset. So if you're a good student from the impairment of assets class, IAS 36, you realize that what happens is that usually there are external factors and internal factors that contribute to an entity's assets depreciating, suffering an impairment. So the examiner is asking us, in accordance with IAS 36, which of the following which of the following would definitely not be an indicator of the potential impairment of an asset or group of assets? Will not be an indicator of impairment of an asset or group of assets. Number an unexpected fall in the value of one or more assets. Yeah, if there is a fall in the value of assets, that's an indicator of impairment, straight up. 2, adverse changes in the economic performance of one or more assets. Definitely, if there is a change in the economic performance, first, the asset could be used to produce 10,000 units, but for some reason, the asset is now being used to produce only 2,000 units. Then it means the asset's production capacity has suffered an impairment. So that is an indicator. 3, a significant change in the technological environment in which an asset is employed, making its software efficiently obsolete. Okay, so if there is a technological advancement, that means that asset is obsolete. So again, that is also an indicator there. Then D, the carrying amount of an entity's net assets being below the entity's market capitalization. Being the entities, that is not an indicator, a potential indicator for an asset in that case. So the answer in this case is going to be what? D, because A is correct, B is an indicator, C is an indicator, but the D is not an indicator directly there in that case. So that is the answer to the question 17. Let's go to question 18. What is the total impairment loss? What is the total impairment loss associated with Aphrodite machine at 1st October 20x6? So let's go back to the question. There may be something there that we need to pick up. So stay with me carefully here. A fire at the factory on 1st October 20x6 damaged the machine, leaving it with a lower operating capacity. The accountant considers that Aphrodite Co. will need to recognize an impairment loss in relation to this damage. The accountant has ascertained the following information at 1st October 20x6. So at 1st October 20x6, we've been given the carrying amount of the asset, which is 6760. Then we've been given the equivalent cost of the new asset. Now, really, if you are dealing with equivalent cost of a new asset, if you are dealing with impairments, the cost of a new asset really will not be an issue here. So we're not going to be considering the cost of a new machine here, because that would not help us in the determination of the impairment of the asset under consideration, because this asset is not a new asset, it's an asset that we've been using, so we can't compare its price to a new asset. Then 3, the machine could be sold in its current condition for a gross amount of 45,000. Dismantling cost would be to 2,000. Then workings 4. In its current condition, the machine could operate for 3 years, which gives it a fair value in use figure of 38,685. So let's see exactly what is going on in here. Now, when it comes to dealing with IAS 38, impairment of assets, sorry, IAS 36, impairment of assets, IAS 36. We said that an asset is impaired. So I'm explaining the principle, then we attach the question, okay? An asset is impaired when the carrying amount of the asset is greater than the fair value of the asset. So where the carrying amount of the asset is greater than the recoverable amount, so let me take it that way. When the carrying value of the asset is greater than the recoverable amount of the asset, we say that the asset has suffered what? An impairment. Note that when we say recoverable amount, the recoverable amount of an asset or group of assets, that is a cash generating unit, is the higher of value in use and then fair value less cost to sell. The value in use less and fair value less cost to sell. Fair value less cost to sell is the same as the net book value of the asset. What we will get today if we decide to sell the asset right now. The value in use is simply the future economic benefits that the entity continues to get from the continuous usage of the assets. So this is the future economic benefit from the continuous use of the assets. And usually the value in use has 2 things we need to take into consideration. It has the direct cash flows from the usage of the assets and then the disposal amount or the scrap value at the end of its useful life. So this is the concept about what you need to understand about impairment. So having this principle at the back of your mind, let's go back to the question and let's pick our items up. So the carrying amount of the asset has been given to us to be, as stated in the question, 60,750. That's the carrying amount. So we need to get a recoverable amount. But the examiner has given us a clue. 1, it says that the machine could be sold in its current condition for a gross amount of 45,000. Dismantling cost will amount to 2,000. Now the dismantling cost here is going to be like the cost to sell the asset. In other words, if we are going to be selling the asset, we have to sell the asset by dismantling it. So that is going to be the fair value less cost to sell, or the net realizable value. So the net realizable value is going to be the 45,000 minus the 2,000. So we're actually going to get 43,000 if we want to sell the assets today. Now, Nana Kwatin said, so say, I would like to know that in calculating depreciation, you will only consider expired years only when revaluation is done, right? I don't know the concept of what you mean by expired years, but you will consider, it depends on the question. If the question says the remaining useful life remains unchanged, then you have to look at the previous year that you used the asset and deduct it from the total useful life so that you get the remaining life. Because once an asset is revalued, we now have to depreciate it using the remaining life of the asset. Okay, we now depreciate it using the remaining life of the asset. Then we are also told that in its current condition, the machine could operate for 3 more years, which gives its value in use figure to be 38,685. So that is value in use. $38,685. So if you look at it, we said that the recoverable amount is the higher of value in use and fair value less cost to sell. So if you check in this question, the net realizable value is 43,000. The value in use is 38,685. So which one is higher? The one that is higher is the net realizable value. So that becomes what? Our recoverable amount, 43,000. So the recoverable amount becomes what? The net realizable value. So if you check, we bring in the carrying amount, which is 6750.